Check, check, check. It's radio check time. I was just over on the YouTube Shorts and TikTok, created a 1 minute video for a small account. If I had a small account, I would be studying credit spreads voraciously. Now, before we move on, though, said it before and I'll say it again. This is not investment advice. This is just some kook living in his basement trading options on his Obama phone. So don't follow any of my advice without doing your own research and investigation first. This is for entertainment purposes only. But if I had a small account, I would be looking at credit spreads. And I did a live credit spread trade of the Google. You know how I feel. You don't have to say it again, Bart. We know how you feel about the Google. I do love Google right now. It just keeps going on down the road, though, doesn't it? Downtown to Chinatown. If we look at the Googler right here, if you look over at February 7th, it was at almost $108 a share. Then it's been, hello, down, look out below, all the way down to where it's at now, which is $90.60. And for reference, it is Thursday, February 23rd at 12:55 p.m. Central Standard Time. But we do like the Googler, but it is going down. So as far as a credit spread is concerned, the most premium you're going to get is where the most risk is. So when a stock is going down and you want to do a credit spread, it would be a put credit spread because that would give you the most premium. And we'll look at that, but I wanted to take a closer look at Google here. Our friends over at Alpha Spread, they feel that the Googler is currently undervalued by 15%, and that's on a base case scenario. And then you take a look at this company. Look at its profitability score, 72, solvency score, 82, revenues, 283 billion with a net income of 60 billion. Hello, Cleveland. And then look at the assets. Cash and short-term investments, 114 billion. Come on now. That's a lot of dough, ray, and me's. So between total assets and liabilities, they got a pretty sound company there. And as far as moats are concerned, because you know our friend Warren Buffett, he likes companies with the moats, like Coca-Cola with the sugar water and Apple with their incredible technology, iPhones, MacBooks, iPads, Apple Watches. That is considered a moat. Well, Google has a moat as well, because you don't say Google it because Google doesn't have a moat. And you don't become a YouTuber. Hey, isn't this on YouTube, Bart? Are you a YouTuber? Apparently, because I'm on the YouTube, I'm indeed a YouTuber. You don't say those things unless you have a company that you like, a company with a moat. I like the Google, and I think it's just being beat up right now. The stock market, the market, those out there that probably know more than I do, but I don't think they do in this scenario. They're being a little bratty with this stock just because it's AI. Had a little bit of a hiccup. I mean, it answered a question that you would have never been able to answer. I certainly wouldn't have been able to answer. And it got just one little detail of it wrong. And some propeller head pointed that out. And I think the stock has been being abused since then. But look at over on the Seeking Alpha. We have the authors at Seeking Alpha. They have it have it at a 382. That's a buy. And then Wall Street has it as a strong buy at 4.54 on a 5 scale. So if we look down here at the factor grades, valuation, they're calling it a C minus, growth a C, profitability A plus. And guess what? When it comes to companies we want to invest in, it's important for them to have profitability. So I wanted to recreate the credit spread trade right before your very eyes, just so I can discuss it in a little bit more detail than I can in a 1 minute video. So let's head on over to the Robinhood and we'll go to Google. Hey, it's right there. Yes, it is, because we were looking at it earlier. And we're going to trade this out. And for math purposes, because I'm not great in math, we're going to do a trade that's 1 month out. Okay, so the first part of this trade, because Google is down today, 1.31%. Let's just take a look. If we were to do a call credit spread, you can see how the percentage of change, so that's the percentage of change of the premium. Okay, so you can see how low these premiums are on the call side. If we were to do a call credit spread, in fact, let's do it. Let's set it up here. Let's go down to March 24th. That's 29 days out to try to do simple math is what our return on investment could be on these types of trades. So if we go to March 24th, 29 days away, and if we were to look at the opposite side of a put credit spread, that would be a call credit spread. And the beauty of both of these types of trades is you don't have to own any of the stock. Wait, how's that possible, Bart? Because you're basically hedging your own position. So we'll look at that. So you don't have to own any Google to sell a call with regard to a credit spread, because you're going to buy a put right after you sell the call. And that's going to be your downside risk. That's going to prevent you from having a naked call that could have, of course, infinity loss for you and cause you some real problems. So if we look at, let's go to about 80%. So if we go to 81%, all right. So here's 81% on this call spread. So if we were to buy, or I'm sorry, if we were to sell at 81%, this 97 strike 1 month out, we would get a credit of $1.23. And then to hedge that, if we turned around and we bought a call at one strike further out at $1.04, okay, so we would pay $1.04 in order to buy that call. And that's our downside protection in case that stock starts going to the moon and crosses through both of these strike prices. They trigger automatically. And what we lose is what's in between the width of this strike. So if we look down here, max loss is $78. So off the top, it's actually $1 wide. $1 times 100 shares is $100. So it's $100 minus what we collect on this position. So right now, we would collect $22. That would give us a max loss of $78. Okay, that's if Google runs up through these strike prices between now and March 24th, which is 1 month out. Now, if we continue with this trade, we'll see. Okay, so it's a low likelihood to fill. We're not trying to fill it yet because I'm looking to do a put credit spread, because I do think Google is going to be going up in the next 30 days. So I want to be on the opposite side of this trade, and I want to be on the put side because I feel that Google is going to be even to up over the next 30 days. What do I know? Basically nothing, but that's just what my goofy gut is telling me. All right, so if we review this order, it's going to show us that we're going to have to cough up $100 in collateral. Okay, so $100 in collateral means that it's the difference between these two spreads. And $100 in collateral, if you were to make $22 on that trade, that would be a 22% return on your $100 in 30 days. That's, of course, a huge number. The risk is that it blows right through here and you lose your $100 collateral minus what you collected in this credit, because that goes into your pocket right now and it stays there. But your risk is right through here. Google goes up, goes from 90.66 all the way through your call, all the way through the call that you bought, and you are out. Now, your broker will handle the details of that if that occurs. You don't have to actually do anything. You could manipulate this trade between now and March 24th, depending on if the position is going with you and you've already collected most of your $22 profit, or you can roll your way and close that position out if you think it's going to get worse on you if the position turned against you. So let's look at the reverse side, which is the position we put on in the TikTok and YouTube short video, and that would be the put side. Okay, so my theory on the Googler here is that between now and March 24th, over the next 29 days, I don't think Google is going to continue to tumble like it's been doing, but I don't know. I mean, the credit spread is like buying an option. You know, I always say this, and you'll hear me say it over and over again. Buying options is kind of like the gambler. and selling options is the casino. So I like to sell options, but on a credit spread, you're essentially making a gamble based on how you feel a asset, an underlying, a stock like Google is going to move over whatever time frame you use for an expiration. So in this case, we're going to ease on down the road. We're going to ease on down here to $84, okay? And we're going to sell a put at $84 bills. And then right after, excuse me, at $83, we're going to buy a put, okay? And it's going to be currently at $97. So our credit is 17. Hey, that's less than on the call side. It is, but again, my feeling is that this stock, Google, between now and March 24th is going to be flat to up, okay, positive. So that makes me feel that the safer side of this particular trade is on the put credit spread. And there it is, put credit spread. We are going to sell an $84 put and we're going to collect $113 and then we're going to buy an $83 put and that's going to cost us 96 cents, which of course is 100 contracts, $96. So currently we would walk away with 17 cents per share times 100 shares is $17, and that gives us a 17% return in 30 days if indeed Google doesn't continue all the way down through our strike prices that are in this position. So that's what we have. I was going to pull the trigger live. I'd like to get another penny so we can actually ask for another penny or two if we want. Okay, so we're going to put up $100 in collateral and we can make as much as $19 right there. So let's try to do that. And if we do, that's going to be $19 on our $100 collateral, which carry the one, that's a 19% return in only 29 days. However, we could end up with $100 minus $19 loss. Is that correct? Yes, that's correct. So that's our max loss. So it's not a huge risky play, but if you only have a $500 account, you're risking 20% of your account. But it is a options trade that you can make with a small account and return big percentages on your money. And you can continue down here where your likelihood of creating a profit continues. I mean, you could come all the way down to 81 and 80 and look at the difference between these two. And of course, you're going to be at a lower credit, but that's also because you are mitigating your risk and you are entering a higher probability of profit trade in order to do so as an exchange for a more conservative approach. So right now, we would be at $18 as far as our credit is concerned. We'll try for the 18. Actually, we'll try for that 19. Let's try for the 19. And there's our $100 collateral. Hey, we went back down to 18. What I'm going to do is I'm just going to go back and I'm going to put in the 19. That's what I want. It probably won't fill right now, but I'm going to put it on for the rest of the day. Good for the day. I'm going to try for that $19 credit, which is 19 cents times 100 shares. And I'm going to try to make that 19% return on my $100 collateral. So there's our $100 collateral, trying to collect $19 on that in 29 days. That's 19%. So we'll do that. It likely won't fill right now, but it'll automatically attempt to fill all day long. So there, let's put that into place. And as you see, it has not filled. We've got 0 of 1, but I will just leave that and we'll check back with it in a video in the future to check on the progress of these credit spread trades. But I wanted to share that with you in case you want to make some options trades on a small account. I would first look into, go to YouTube, go onto the Googler, go on to Amazon, find as much material as you can on credit spreads, study that, look at the probabilities, look at the Greeks, look at all that would make you a more educated trader, and then look at call and put credit spreads and try to enter conservative positions. You don't need to make 100% return in 1 month like you see on all of the TikTok, all the other TikTok videos, and over there on the Wall Street bets. But you can make a very nice return on your money and grow that small account, even with a conservative position on credit spreads. Just remember, this is this is essentially a gamble on the market based on the research you do on a particular stock. Because I could be trying to catch a falling knife here on Google because I think it so highly of Google. I mean, it could even be a falling diaper, right, Bart? Yeah, it could be a falling dirty diaper. But what we're hoping for it to be is we want to catch a goose, a falling goose, preferably golden. So we'll look at that. I'll continue to keep an eye to see if that's filled today. I'll keep you posted on that, but I appreciate you checking in with me, checking in live here on a Thursday. If you can do me a huge favor and subscribe to the channel, like the video, leave me some comments, I would appreciate it. And guess what I'll do? I'll see you in the next video.